Good afternoon. I'm David Luberoff, the Center's Deputy Director, and it's my pleasure to welcome you to today's talk by Whitney Airgood-Obrycki on the current state of U.S. rental markets. Before I introduce Whitney, I want to let you know about some other upcoming talks. Our speaker series will continue next Tuesday at 11 a.m. when we'll hear from GW School of Business Professor Vanessa Perry, who's written extensively on race and racism in mortgage lending. Vanessa's talk is the first of 4 talks on housing finance and social equity that we're co-sponsoring with MIT's Department of Urban Studies and Planning and its Golub Center for Finance and Policy. Those talks will be weekly on Tuesdays from February 28th until March 21st, and they'll be hybrid events with the in-person portion taking place at MIT. A week from today, on Friday, March 3rd, Alex Herman, a research associate here at the Joint Center, will discuss a forthcoming working paper on the geography of renter financial distress and housing insecurity during the pandemic. Alex is a co-author of that paper, along with Whitney and our colleagues Sophia Wadeen and Chris Herbert. I also want to note that on Thursday, March 23rd, we'll have an online panel discussion to mark the release of our biennial Improving America's Housing Report. And 5 days later, on the evening of Tuesday, March 28th, Andy Bernheimer, a New York-based architect whose firm has designed several notable new affordable housing projects, will give the 22nd annual John T. Dunlap Lecture. That'll be a hybrid event. The in-person portion will be at Harvard's Graduate School of Design. More information about these and many other upcoming events are available on our website. And now on to today's presentation. Our speaker, Whitney Airgood-Obrycki, is a senior research associate here at the center and one of our lead researchers in a stream of research on rental housing, much of it funded by Wells Fargo, which is the primary funder of the America's Rental Housing Report. Whitney has been the lead author of the last 2 of those reports, which were released in 2020 and 2022, and she'll be the lead author of the next version of that report, which will be released early next year. Given the rapid ways that rental markets can and usually do change between those reports, we asked Whitney to discuss where we are a year after the last version of that report, which, as you surely recall, was released at a time when rental markets were surging and there were growing concerns about affordability. Whitney will speak for about 25 to 30 minutes and then answer your questions for about a half an hour. You can submit those questions via Zoom's Q&A feature, where you can also indicate your interest in questions posed by others. We'll wrap things up by about 1:15 p.m. Later today, we will be posting a video of the event on our website in case you missed some of it or aren't able to stay for all of it or want to tell somebody else about it. My apologies in advance if it seems quite likely we don't get to all of your questions, and my thanks to my colleagues Sophia Wadeen and Chris Herbert, who will be monitoring those questions and, where possible, answering all of them online. Whitney, it's all yours.
Thanks so much, David. I'm going to share my screen, get some slides running. Okay, well, welcome everybody, and thank you for joining us today. As David mentioned, America's Rental Housing is a report that we do every other year with the support of Wells Fargo, and their support also makes our other work on renters, rental housing, and rental markets possible, including this update today. The biennial rental report is always a really great opportunity for us to take a deep dive into rental conditions. And today's presentation is just an update on that work 1 year after our last America's Rental Housing Report and 1 year before our next rental report. It's a particularly good time for an update as well, given the difference that 1 year has made. So we're really grateful to Wells Fargo for their ongoing support and are glad you all are joining us today. So just to take a step back and remind you, at the time we finished writing the last report, we had market data through the third quarter of 2021, and these were some of the key themes that we found. First, the rental market was rebounding rapidly with substantial rent growth and ultra-low vacancies. Demand was surging at record highs, and the long-term trend was in higher income households driving that demand. Multifamily construction was booming at about a 40-year high, but we were seeing a lot of affordability challenges that the pandemic only exacerbated. And this was evident in the high share of renter households who were behind on rent. In response, though, there were unprecedented resources that helped stabilize renters and keep them in their homes. But ultimately, we were left with several unmet needs that highlighted the urgent importance of reinforcing the housing safety net. So here we are a year later. Rental markets are at an inflection point, and though a lot has changed, many of the same challenges remain. Some of the themes that we're seeing now are, first of all, a cooling rental market characterized by slowing demand, decelerating rent growth, and rising vacancy rates. There has been continued strong multifamily construction, and we're also still seeing deepening affordability challenges that are especially showing up in the latest data on cost burdens. We're also seeing rising housing insecurity in the form of evictions and increased homelessness, but there has been some momentum out of the pandemic with the current administration and also on the part of state and local governments that have yielded some policy bright spots. So with the time I have today, I'm going to go through each of these themes and just show some of the current data that we're looking at and where things stand now. So first, in terms of markets cooling, rental demand surged in the second year of the pandemic before slowing last year. This chart is data from RealPage, and they track professionally managed apartments. The line is showing the net change in occupied units, and here you can see that dramatic surge and then the quick drop off in rental demand. So at the time of last year's report, demand had come out of that 2020 slump and hit record highs. And after our report, that continued into 2022, reaching a peak of nearly 700,000 net new leases in the first quarter for apartments. You can also see the sharp decline in demand as 2022 progressed, though. So by the fourth quarter of last year, RealPage was reporting a net decrease of just over 100,000 occupied units. And notably, that was the first drop in demand that they'd recorded since 2009. The Housing Vacancy Survey, which covers a broader swath of the market than just professionally managed apartments, also showed slowing demand after a bump in 2021. But even so, the HVS recorded the highest number of renter households in recent decades at nearly 44 million in 2022, while the rentership rate simultaneously dropped more than a percentage rate during the pandemic to 34.3%. Though this data is lagged, the latest American Community Survey also points to shifts in the composition of demand. So before the pandemic, higher income households who make at least $75,000 a year were driving increases in overall demand. From 2011 to 2019, there was a nearly 4 million household increase in higher income renters, and that group is shown on that dark orange line on this chart. If you look at the most recent years, you can see that the pandemic was the first reversal of this trend, with an actual net decrease of nearly 279,000 higher income households just from 2019 to 2021. Some of these households went to the homeownership market, while others dissolved into smaller, lower income households. And when we look further at where the largest increases in demand have come from, we do indeed see it's been in lower income households making less than $30,000. And you can see part of that trend from the blue line on this chart with that little uptick at the end. And there's also been an increase in the number of smaller 1 or 2 person households as well. With the slowing of demand, we're also seeing rent growth starting to cool. This is data from CoStar on professionally managed apartments again. And the filled blue area is all apartments that they track. So you can really see this fast pace of asking rent increases after that initial slump at the start of the pandemic. Rent growth hit a peak of over 11% in the first quarter of last year, before slowing to a more typical pace of 3.4% at the end of the year. The highest quality apartments, which are shown on the purple line, saw rents dip modestly in the first year of the pandemic before they topped out at more than 13% growth by the end of 2021. We've since seen a rapid deceleration from that really fast pace, with rents rising just 2.8% year over year at the end of 2022. In the lowest quality sector then, which is shown on the yellow line, rents continued to rise throughout the pandemic, with growth accelerating to just over 6% at the beginning of last year. While rent growth in the highest quality apartments dropped off quickly, the lowest quality apartments were still seeing increases of over 4% at the end of last year. So this is a segment of the market that really hasn't seen any relief. The abrupt change in rents was widespread across the country. And this chart shows data from RealPage in the fourth quarter of each year. So this is 2020 on the left, 2021 in the middle, and 2022 on the right, all fourth quarter. The bars then are the share of markets that fall into each rent growth category. So on the far left panel, you can see the dip in rents occurring in markets across the country as the pandemic took hold. That's that blue bar. In 2021, the middle panel, rents grew by at least 10% in 2/3 of the markets tracked, which is shown on the yellow bar. And most of the remaining third saw rents rise by at least 5%, which is the addition of that purple bar. Then on the far right panel, you can see how things shifted at the end of last year. In the fourth quarter, just 14% of markets posted rent growth over 10%, and 69% of markets were in that 5 to 9.9% range shown on the purple bar. With cooling demand and new construction coming online, vacancy rates were also rising. This chart shows the vacancy rate from CoStar in the shaded blue, and then the orange line is just the 20-year average of that data for comparison. In the last quarter of 2022, the vacancy rate for professionally managed apartments was back at 6.4%. This was a pretty significant increase over the historic low of 4.7% from mid-2021, but it put vacancies basically back on par with the long run average. So you can see that most recent reading is nearly converging with the orange line. And like the rent growth story, rising vacancies were also common across markets. And you'll notice this is a similar chart to the rent growth one from before, but this time we're showing the year-over-year percentage point change in vacancy rates. So in the last quarter of 2020, which is again that far left panel, vacancies were starting to decrease as demand picked up, with tightening in almost 2/3 of markets that are presented there on the blue bar. Almost every market was tightening at the end of 2021 on that middle panel as vacancy rates continue to fall. You see that blue bar going up. And then in the right pane, you can see that at the end of last year, 17% of markets tracked saw vacancies rise by at least 3 percentage points, which is a pretty big year-over-year increase shown on the yellow bar. And an additional 62% of markets saw vacancies rise by at least 1.5 points, which is that purple bar. Just 2% of markets then had decreasing vacancy rates, which was a huge turnaround from the year prior. Part of the rise in vacancy rates was a result of sustained construction, with new completions hitting markets at a time when demand was also tapering off. And we can see the steady continuation of strong multifamily construction shown on this chart. So this is the number of multifamily units that were started, under construction, and then completed by each year. The purple line is completions and shows that more than 370,000 multifamily units were completed by the end of 2022. An additional 545,000 units were started last year, shown on that orange line. And then if you look at that soaring blue line up at the top, those are units that are under construction. And the number hit about 936,000 units in 2022. And when you compare that to this long-term trend over time, you see that that's the highest level in more than 40 years. At the same time, there's a growing number of single-family homes that are built specifically to be rented. It's still a small share of overall rental construction, but the number of starts hit 69,000 in 2022, and that was up from 39,000 just 2 years before. So given this momentum in that sector, as well as the huge number of units that are currently under construction, we should have quite a few completions that are delivered in coming years. But there are also early signs from this year, from the January numbers, that there could be some cooling market conditions that are contributing to a slowdown in starts. Even with the cooling of markets, though, there has still been a lot of continued investment in rental housing, though it's at a lower level than it was at the peak of the pandemic. So the chart shows the volume of apartment transactions in billions of dollars on the blue bars, which correspond to the left axis. And then the line is year-over-year apartment price appreciation, and that goes with the right axis. So there have certainly been some concerns about the increased expense of owning and managing rental units as well as acquiring them. And there's some uncertainty about demand going forward, but this doesn't really seem to have slowed investment too much. So according to this data from CoStar, transactions were down about 20% year over year in the last quarter of 2022. But when you look at that last bar, you see this is still higher than pre-pandemic levels. So still a lot of investment happening. Apartment prices are continuing to rise, though at a decelerated pace. But again, this pace is still faster than what we saw pre-pandemic. There are other signs of possibly slowing investment in the broader housing market that could have implications for rental, such as Redfin reporting that investors bought about half as many homes at the end of 2022 as compared to the year before. But even so, Redfin found that 18% of homes in the fourth quarter of 2022 were purchased by investors, which was still an elevated level. So this is a trend that, of course, we're going to continue to watch and keep an eye on. Changing ownership, the kinds of construction that's happening, and also the long run increase in higher income renters all have potential implications for the distribution of rents. And one thing we've been tracking is the loss of low rent units. This chart shows the shifting distribution of rents, and the low rent units are shown on the orange line that we're going to focus on. These have contract rents under $600, and all of these numbers are inflation adjusted to 2021 dollars. So it's a kind of apples to apples comparison. The number of low rent units has declined every year since 2011, and there was a sizable drop of nearly 1.2 million units from 2019 to 2021 alone. Over the last 10 years, this has amounted to a total drop of nearly 4 million low rent units, and the low rent share of the stock simultaneously went from 28% in 2011 to just 18% of the stock in 2021. The loss of these low rent units has contributed to rising cost burdens. On this chart, the stacked column shows the number of moderately and severely cost burdened renters, which corresponds to the left axis. And then the line is the share of renters with cost burdens, and that goes with the right axis. So households are considered to be cost burdened if they spend more than 30% of their incomes on rent and utilities, and then severely cost burdened households spend more than 50% of their incomes on their housing expenses. The number of cost burdened renters hit a 20-year high of 21.6 million households in 2021. That marked an increase of a full 1.2 million households since the start of the pandemic. And it also included a record 11.6 million renter households who were severely burdened. This was also just a significant jump in the context of those pre-pandemic years as well, when cost burdens had sort of decreased and leveled off a little bit. Meanwhile, the share of cost burdened renters also increased during the pandemic, rising more than 2 percentage points to 49%. And if you look at that line, you can see the rate was only slightly below the all-time high that was set in 2011. The other thing we're seeing right now is cost burdens increasing across every income group. Lower income households making less than $30,000 have had persistently high burden rates over time. And they're so high to the point that you would think that they couldn't possibly increase much more. But we actually saw them rise by more than 1.5 points during the pandemic to 83%. Before the pandemic, cost burdens were rising fastest for middle income renters, who are shown sort of in the middle section of this chart. And these households make between $30,000 and $75,000. And the pandemic was a continuation of that trend. The share of these households who are cost burdened increased by more than 3 percentage points, and that hit a new high of 46% in 2021 for that income group. And even higher income households, who are shown on the right part of the left panel, had a rising cost burden rate, though it still stayed below 10%, and they're in a relatively, better position than other income groups. Worsening cost burdens has also translated into households having less money left over after they pay rent each month, which I'm going to refer to here as residual income. The chart on the left shows the percent change in residual income, and it's all relative to 2001. And then the lines are breaking this out by income category. So the lowest income renters, making less than $30,000 per year, had an astounding drop in residual income during the pandemic as rents rose and income stagnated in this group. Their residual income, which is shown on the orange line, was a full 35% lower than what they had in 2001. And this is, again, inflation adjusted. Middle income renters, who are shown on that blue line, are also faring worse, with a 7% drop in residual income since 2001, and that's the product of further declines during the pandemic as well. The highest income households were also affected by rising cost burdens during the pandemic, but their residual income is still higher than it was in 2001. The right chart then gives the actual residual income amounts, and these are the medians for each income group. So the far left very short bar is the lowest income renters who have less than $400 each month after paying rent. And this is quite obviously an amount that falls well short of a decent standard of living in even the most affordable places. The rising cost of consumer goods and services, though, is also putting pressure on the little amount that households have left over. These data come from the Census Household Pulse Survey, which in the last half of a year added a question about whether respondents think the price of goods and services had increased in the 2 months before they were surveyed. And they were then asked about how stressful price increases were to them. A full 52% of all renters reported that recent price increases in consumer goods were very stressful, while an additional 24% found them to be moderately stressful. This chart shows the share of households who were reporting that price increases were very stressful, and it breaks it out by demographic characteristics. Lower income households, which are shown in the orange bars on the top, had the highest rate of feeling very stressed, as did Hispanic and Black households, which is from the middle section of the chart in purple. And these households tend to have lower average residual incomes due to persistent discrimination in education, employment, and housing. And perhaps very unsurprisingly, you can see on the bottom blue bars here that about 3/4 of renters who were behind on rent when they were surveyed reported that they were very stressed by the rising cost of other goods and services, showing how they're sort of pinched from all directions there. Households have less left over and are being hit with inflation, also at a time when rental assistance is also being depleted in many places. In the last half of 2022, a full 13% of renter households still reported that they were behind on rent payments, and all things considered, this wasn't much lower than at the height of the pandemic. And this was also despite a very robust economic recovery as well. And we continued to see lower income households who were hit hardest by the pandemic and who had persistently high cost burdens to start with now have the highest likelihood of being behind on rent. We also see on the purple bars that households of color are more likely to be in arrears, again reflecting systemic racism and the disparate burden of pandemic job losses. Several pandemic relief measures, including eviction moratoria and emergency rental assistance, are winding down or expired, as many renters still have difficulty making rent. And we're seeing evictions rise as a result. This chart uses data from Eviction Lab to show eviction filings relative to a pre-pandemic average. So 100% would mean that evictions are at the same level as they averaged in that month from 2012 to 2016. The red line is showing levels from 2020, when evictions dropped rapidly as measures were put in place. Evictions continued to rise through 2021, which you can see from that yellow line being higher than the red. And then the last year is shown in blue, and you can see eviction levels were at more than 80% of pre-pandemic averages. Rising housing insecurity is also evident in homelessness trends. This chart is showing the number of unhoused individuals on the left, and then it's the number of people in families with children on the right. The purple bars are the number of people in shelters, while the orange are people in unsheltered locations. The total number of people experiencing homelessness rose from January 2020 to 2022, and this chart shows that the increase came from individuals living in unsheltered locations, which was a continuation of the pre-pandemic trend. And in fact, in 2022, the number of unsheltered individuals rose by more than 7,000. I'm sorry. Despite signs of market cooling then, there are still immense unmet needs, and the market just does not serve lower income households particularly well. There were several policy bright spots last year and ongoing that are encouraging, though more is likely needed to address the affordability crisis. So these are just a few examples of some of the policy momentum we saw in the last year. And first, we have a supply that is still really constrained in some markets, and there are varying estimates as to how much we need, but there's agreement that there is sort of an overall housing shortage. Several places have relaxed zoning to allow multifamily construction, and Maine was the most recent statewide reform to increase the types of housing that can be built and the densities of housing. Here in Massachusetts, communities that are served by transit have started to submit their plans for districts where multifamily housing can be built as of right. At the federal level, the omnibus bill also included $85 million in HUD grants for cities to encourage zoning reforms and expand where multifamily housing can be built. The omnibus bill also included funding to renew contracts for assisted HUD housing for the lowest income renters, and it also modestly expanded tenant-based assistance. The bill further provided the largest boost ever to homelessness assistance grants. At the state and local level, there are still state and local fiscal recovery funds that are to be deployed out of the American Rescue Plan. The latest Treasury report showed that state and local governments had dedicated more than $14 billion of their funds for meeting short and longer term housing needs in their communities. Voters across the country also approved nearly $2 billion in state and local affordable housing bonds last year, according to the National Low-Income Housing Coalition. The pandemic has created a lot of momentum for eviction prevention programs as well. HUD has funding rounds for tenant representation, and several state and local governments recently enacted right to counsel legislation to ensure that at-risk renters have legal representation. And in addition to the increases in homelessness assistance grants, the U.S. Interagency Council on Homelessness has issued a strategic plan to reduce homelessness by 25% by January 2025, which builds on the House America initiative launched in 2021 that has already permanently housed 100,000 people in 150 communities. So we are seeing various bright spots and some policy movement that will help make a dent in the affordability and housing insecurity crises. But again, we're just seeing overwhelming need right now. So with that, I would like to again thank Wells Fargo for their support of our rental work. There will be more on all of this coming up in our State of the Nation's housing report that comes out in the summer. And then of course, there's going to be even more in the next America's Rental Housing Report coming up next year. I'm again like to thank everyone for joining us, and I think I'm going to pass it back to David, who's going to throw some questions.
Yes, thank you, Whitney. That was tremendous amount of information presented really clearly. We've got a really wide array of questions, so it probably will feel like they're being thrown in. Let me start with. You showed a couple of really interesting charts showing, variation, the real page charts on, for example, the share of metro areas where rents had increased dramatically or vacancy rates had increased dramatically. Can you say anything about, more specifically, is there particular parts of the country or particular types of metros or just particular metros where the data seems to suggest things are changing, especially dramatically?
I think it suggests that it is rather widespread. We are seeing like some of the metros that had really fast rent increases during the pandemic start to slow. So if you think about places where you just saw like rents absolutely explode, that was sort of an unsustainable pace, and now they're starting to decrease in pace. But I think it's pretty remarkable how widespread a lot of these trends have been across the country, really.
And I guess related to that, it looked like you said there were, at this point, only a handful of places where rents had actually declined. And again, did those tend to be places where rents had risen dramatically?
I don't have that off the top of my head,
Okay.
unfortunately. Got me with one foot off the merry-go-round.
It sort of comes. Um, a couple of questions about whether or not we have seen impacts of two types of policies that we're seeing increasingly at state and local levels. And it may well be that it's just too soon to tell, but I want to at least make sure that these get raised. One would be the efforts to allow more multifamily construction, so Maine, California, Oregon, et cetera. And the other is the several states and jurisdictions that have created some new form of rent regulation, and whether or not we're seeing the effects of that either on rents or supply or both.
So I think some of the initial data on zoning reforms doesn't suggest that there's been, like a rush of building. I think in California, where some of the ADU permitting allowed things to be, brought into the formal sector, showed a big increase in permits in part because of that. I think part of what we're seeing though is that removing the barrier is the first step, but it doesn't necessarily guarantee that development is going to happen, or that it's going to especially reach the lowest income households who also have like the greatest affordability challenges. In terms of rent control and rent regulation, I think there was some, evidence out of St. Paul and Minneapolis that suggested may have stopped or slowed construction. But I don't know that we've seen like a large scale definitive study about, the role of rent regulation, rent control in, actually in practice, slowing construction. So yeah, I think part of what the policy momentum right now is like, we have all of these barriers to construction. And if we remove some of the initial barriers to at least allow it to happen, we're seeing that this is like the first step, but we probably need to do more to really encourage development.
Yeah, I think I know there's some other research by some of our colleagues talking about the need to create almost a whole ecosystem. There are a couple of questions that I'm going to group together around digitalization. And one is, and again, I'm not sure we've done this or even could think about exactly how to do it. The impact of, as you noted, they're increasing kind of investor ownership, particularly in single family rentals. Do we know anything about how that's affecting rents and affordability? And the related question is, have you had a chance to look at all about the use of algorithms that investors are using to set rents coming out of entities like RealPage, or familiar with work that's being done on that?
So on the first question about sort of the role of investors and potentially raising rents, I don't know that I've seen like good comprehensive empirical work on that. There are certainly a lot of anecdotes and a lot of, market level work that looks at, the impact of investors on potentially raising fees. There's certainly like, if you have shareholders that you're beholden to, there might be an incentive to raise rents. And, there have been reports about potential issues of quality and evictions as well. But I think on a, we've seen that investors are sort of concentrated in some markets, and I don't know that we've seen a full empirical look at what that means for, for rents, for vacancies, for evictions, to really get at some of those questions. And then in terms of algorithms, I've certainly been following what's going on with RealPage and with some of that, I guess, investigation. And I don't really know. I think algorithms, part of the problem is it's a black box and we don't really know what's going on behind the scenes. So there's a potential for things to be happening that we can't really see. But I don't have a lot of expertise in digitalization and algorithms myself. So I don't know that I have a great answer to that. It's certainly, it's something to be watching, and it'll be interesting to see how this investigation plays out.
Have you seen, I think there's been some data that's come also looking at evictions and corporate ownership. Is that something you've had a chance to look at all?
The studies I've seen suggest that there are higher rates of eviction with some of these corporate landlords, and that they can have potentially higher rates of repeat evictions. But again, I think a lot of these studies end up being at smaller markets because the data are just so difficult on a larger scale. And so this is still something that I think is something we need to continue studying and understanding who these players are and what their effect is in different markets.
Some questions about that kind of very striking data about the loss of low-income units. Do we have any sense of what happened to those units? Or have they been bought and renovated? Did they disappear? Who knows?
They just evaporated. So I think the common theme here is that we always wish we had better data to answer some of these questions, and that's one of the difficulties of studying rental housing and housing markets. But we do know, so there's a lot of anecdotal evidence. So if you look at Connor Doherty's great book Golden Gates, he highlights a bunch of cases where people are acquiring units and making upgrades and raising rents. So that is certainly happening to some of these. In markets where rents are just rising, you could be a landlord and you just increase your rent potentially without upgrades. Some of these are actually being lost from the market entirely, so they could be demolished if they're lower quality, or they could be converted units, which is probably less likely but possible. So there's these different avenues that these are being lost basically from our data, right? And being shifted into higher categories or just totally lost. But we don't have the data we need to actually track these and see sort of longitudinally what's happening to them.
I was struck by your discussion about the sort of policy bright spots, particularly the federal level. There has been some discussion about my understanding is some of the programs you discussed are coming to an end. And I'm just wondering if you can sort of, if you've had a chance, if you can sort of walk people through kind of where are we in terms of what is likely to continue and what is coming to an end and what the effect of that might be, or what are you looking at?
Yeah. The big thing that is running out is the emergency rental assistance, which has been helping households who are in arrears with their rent and utilities. That has been a huge source of support for renters during the pandemic. I had a paper last summer that looked at sort of what emergency rental assistance does for households, and it just has these amazing benefits for reducing households behind on rent, reducing the number of months they're behind on rent if they are behind, their risk of eviction or how threatened they feel that they're going to be evicted. But it also has these other sort of corollary benefits around being more food secure, having better mental health, and sort of these other benefits. So this has been a really important resource for keeping renters current on rent and also helping landlords to remain financially solvent. So it's been sort of attacking from both sides. And to have that be spent down is really difficult right now. The ongoing things are the state and local fiscal recovery funds. That's just a huge source of funding that governments are using for ongoing support for both homelessness and for long-term affordable housing needs. So that is something we're going to continue to watch, how that money is being used. And then I think just the ongoing support from the omnibus bill and some of these other spending sources, I think is going to be really helpful. We also have on the homeowner side, the homeowner assistance fund, which is similar to emergency rental assistance, but that is also going to be spent down very quickly. So I think one of the challenges when we look at the data, just as a side note too, is that when we still see a very high share of renters reporting that they're behind on rent, this seems to be just baseline renter distress at some point. And so I think it highlights how people fall through the cracks of our existing system.
the sort of follow-up question to that. So we had a question about what do you see as some of the most promising strategies that are being discussed either at the federal or at varying state levels that might take a bite out of some of the particularly the affordability issues?
I think it is encouraging, just on the housing supply shortage side, that they are tying, competitive grants to how exclusionary your zoning is essentially. So I think that could actually move the needle in some places for opening things up to construction that could have effects further down the chain. So I think just having that sort of federal lever pulled for once is kind of interesting. The fact that there is a lot of movement for addressing homelessness too, I think is really exciting. And it's just such a huge and increasing problem right now that, there's a lot being thrown at it from federal, state, and local governments. And it feels like there's enough momentum that something could happen. Same with some of these eviction prevention programs. It feels like the pandemic is this moment where we're all aware of how important housing is, how easy it is to fall into housing insecurity, and how we might be able to actually address it.
I'm going to take up a question here that digs a little bit into what's happening in the different segments of the market. Can you discuss what you might be seeing in terms of rent trends at the high end of the market, the middle end of the market, and the low end of the market?
So at the high end, that's where new construction is really coming online, right? And so at the high end, we saw demand sort of pause early in the pandemic, and that was the place where we saw big rent discounts. And we saw a lot of concessions as well. So things like, the first month free or whatever. And in the meantime, at the middle and lower income segments of the market, things were just kind of chugging along at the same pace. So there was never any relief. The high end, then we saw this just, astronomical increase in asking rents following this sort of modest decline, but that's also come back down really quickly. And now we're actually seeing lower and middle quality apartments have faster paces of rent growth than the highest quality. So again, you have the people who are sort of most crunched in the rental market did not get the relief, didn't get the declines, didn't get the concessions, and are still seeing their rents just continually rise.
Have you laid the there's been a lot of discussion about inflation in the last year broadly, as you may have noticed, and I'm just wondering how, and including efforts to kind of try and pull the extent to which the inflation numbers we're seeing are being driven by increases in housing costs. And I'm just wondering, have you had a chance to lay some of the quarterly rent increase data against inflation in other parts of the economy?
There is a good paper out of one of the feds that looks at sort of the BLS measure of rent inflation and looking at asking rent measures and comparing them. That is a good paper to check out. I think part of what's happening is the rents that we see from CoStar RealPage are asking rent. So that's when you move into a new unit. The CPI measure that is sort of the inflation measure is a much slower moving measure. And so it's lagged. They measure it on 6-month increments because it's different from other goods, right? And it's also capturing lease renewals, which are lower rent levels, lower increases than if you move into a new unit, right? So part of what we're seeing is that we started to see asking rents come down while inflation in the CPI was still going up, right? And so part of that is going to be lagged. I'm not sure if that exactly answers the question, but there is a lot more in the Fed paper it was a really good thing looking at renewals versus asking rents and measuring CPI versus some of the Zillow measures and other proprietary data sets. And so we will see a lag between what's going on with asking rents and then what's going on in the CPI for rent.
somewhat related to the rent question is, are you seeing any significant changes in mobility patterns? I mean, the pandemic was marked by the outflow from the city, the influx into the city. And I'm just wondering, as we settle into whatever stage we're in at this point, if there's any notable shift or return to a pattern, both of I guess where renters may be moving and to a certain extent where where units are being built.
I will say that that's probably not my area of expertise in general. So I haven't looked at the latest migration numbers. I'm sure we will be discussing that in the State of the Nation's housing and in future work. We do have some interesting forthcoming work also coming with Hyo-Jung Lee, who's a former postdoc, and with my colleague Ryan Frost, that's looking at especially where like millennials are moving and investigating some of those changes. So hopefully I'll have more on this in the future, but I don't have a great answer at the moment.
And related, at the beginning of the presentation, you talked a fair bit, some really striking data on the decline in high income renters. Is the presumption that that shift is due to a shift to home ownership among high income renters?
So I think it's a combination of things. We likely saw the highest income households peeling off to homeownership, but because the homeowner market has been so tight, I don't think it fully explains the dip in those households. And some of what we're seeing with the demand shift is that there were actually increases in lower income households. And so it looks like this is also a story of sort of dissolution of those households. So I might have lived with a roommate and we were a 2-earner household, which made us high income. And now with the pandemic, we've split off and now we're each single earner households, right? And so we're now lower income, but we're the same, we have the same incomes, we just have formed a new household. So I suspect that that's a lot of what was going on, especially in the early, 2020, when things were a little looser with the rental market. There were actually vacancies. You could get deals in some places. So there might have been some movement then. Plus, you don't want to live with a roommate when you're working from home and, in the middle of the pandemic. So there was certainly some household formation that came out of that as well that's driving that number.
And that, if I remember correctly, earlier in the presentation, you talked about a rise of smaller households, which would be consistent with that.
Yeah, it's
that story.
And especially, so I think I said that, it's an increase in households making less than $30,000 and an increase in 1- and 2-person households. It's also an increase in lower income households with 1 or 2 people. So it's sort of the crosstab of those two. Is where we're seeing some of the rise.
Yep. There's an interesting question. I'm trying to wrap my mind around it. But I'm going to ask it, which is, to what extent do we think the affordability issue is a rent issue, and to what extent is it an income problem? And how might we think about that? Because that would influence how we might think about policy responses to this really persistent and at some level quite scary affordability issue.
It's certainly a both problem, especially so. For higher income renters, it's probably mostly a rent problem, right? For lower income renters, it's a both problem. And for middle income renters, it's probably somewhere in the middle, right? I will put in a plug for our Rent Eats First paper that we did last year, which was actually looking at residual incomes and whether or not households have enough to meet sort of a basic standard of living. And as part of that paper, we looked at, if you had different policy levers, what would actually move the needle on getting fewer households to be residually cost burdened. And so we did find that, if you gave everybody affordable housing by the 30% standard, you move the needle a little bit, but not all that much, like as much as you think you would, which suggests that it is a big income problem for the lowest income renters, right? And then, looking at different policy levers, you start to see that like you actually have to do a couple of things to get households to be able to get to a basic standard of living. So I think housing affordability is like one piece of the puzzle, but we also need to think holistically about, all of the challenges that households are facing.
Somewhat, we'll call it tangentially related, but everything's about rental housing, so it's always tangentially related. But There's a question about the new. Is there any way to think about the new additions to the housing stock? To what extent is that subsidized, particularly LIHTC funding, and to what extent is it market rate? So is the supply of sort of affordable, permanently affordable housing growing faster, slower than the overall supply? I think is a way to think about that question.
Yeah, it's an interesting question. So I think part of the challenge is that LIHTC is a pretty small chunk of the market, and subsidized housing in general is a pretty small chunk of the market. So even if it's growing faster, it's a faster as a small chunk of the market, right? So I think that's sort of the problem, though, right? Is that we primarily build market rate. We build at the high end. When you look at those like under construction markets, under construction numbers, a lot of them are for $1,500 or more, and then LIHTC is gonna, I think it supports like less than 3 million households at a time or something, right? So the scale is just completely different in some way, right?
Yep. I want to wrap up by kind of stepping back a little bit, and it's almost a three-part question. So when the report came out a year ago, what were you really worried about? Or yeah, I guess worried. What were the things that were really excited about? What were the things that really struck you as things you wanted to pay attention to over the next year? As you did this sort of mid-year review, what really jumped out at you? Lay that against the list of what really jumped out at you. What surprised you? And I guess the third piece of that is, as you think as we now shift, we're starting. We're not starting. We're deep in the work on the state of the nation's housing, and right behind that will be the rental report. Is there anything in particular that you're hoping to dig into as something that's starting to emerge as a topic beyond the important basic metrics that we're always tracking? So what surprised?
So what
worried you? What surprised you? And what are you watching?
Oh gosh. So
and you can take any mix of that you want.
The last report, I was very worried about where households were at. And I think I'm even more worried this year, but just like looking at the pace of rent increases and knowing how strapped households were going into things, I was just in like assistance not getting to everybody who needed it. I just like, I feel for every household who just like it can't make it, right? And these are working households in a lot of cases, who are really striving, really trying to make it. So I think when I look at these numbers, I just see like on a human level, these lower income renters who have less than $400 a month left over, like how are they making it work, right? And that I think is the piece that is always very striking and very concerning to me. The thing that I thought was like sort of hopeful though was that we do have this increased attention for rental housing. We had this like, we're going to support renters through the pandemic sort of mentality. And it seemed like there was a lot of movement on things, and the possibility that we might actually like increase the housing safety net and maybe even permanently, that I thought was pretty exciting. This time around, doing this update, it is like a really interesting moment to be doing this. It does seem like we're at an inflection point. And I think the thing that I'm interested in now is just understanding where things are going next. And, I think a lot of that is tied to like consumer confidence, is tied to the economic recovery and, unemployment levels, and just, people getting some kind of bearing on where we are at this point, still in the pandemic. So, I think that is one of the things that's interesting this time, is just how much uncertainty there is, how much difficulty there still appears to be with affordability challenges and with housing instability, even though things are starting to cool off. And then going forward, I think there are a lot of things on sort of a wish list of things I wish I could study and knew more about and had the data for, basically. I think the role of investors, as we mentioned earlier, is just a huge question. What they're doing to the market, what it's doing to specific markets, what's the effect on renter households, on the stock, on other owners, I think are some big questions that we're always trying to see if we can explore further. And I think that's sort of top of mind right now. So and I think that, looking at renter instability and affordability challenges is always my personal interest. So I'm certainly excited to dig more into that and see, especially when we get the 2022 data, like what's going on, and if 2021 was kind of a blip or not.
Yeah, and it also, I thought you put an interesting pin at the beginning in the question of, is this sort of surge of new supply going to continue? We've at least seen some signs that things may not continue as much. Just listening to you, I'm reminded again of just how much ground you managed to cover in you and the team managed to cover in these reports, how much work it is, and also that also reflects just how complicated the world of rental housing is. I also really appreciate that you brought it back to the fact that we in the end are talking about people living in housing and whether or not they can afford it. I think the numbers that you showed in particular about residual income are just stunning, and you just wind up scratching your head. And I really appreciate the reminder you gave, putting a pin in saying these are real people really trying to make it, who have been dramatically affected. I'm really glad we did this kind of mid-course review. I again want to thank our friends at Wells for providing the support and truthfully encouraging us to step back at kind of the midpoint and see where we are at. And I thank you for just a wonderful tour de force, and of course look forward to reading about it. And I note that a couple of the things that Whitney touched on are in fact the subject of some upcoming seminars, most notably next week's seminar with Alex Herman on the geography of renters through the pandemic. So I hope everyone else enjoyed this as much as I have. I thank you for attending. I'm sorry we didn't get to all of your incredibly terrific questions. We do archive them and look back at them because they're sometimes very helpful as we go forward with our research. And as I said, this session will be available online. Whitney, on behalf of everybody, thank you very, very much.
Thank you all.